Well, good morning again, and welcome to our weekly presentation on life insurance. Mark Conter here at the Messer Financial Office. A couple of little housekeeping items before we get started today. Make sure that your personal phone is muted. And please also, during our presentation, if you have questions, just type them in that question box you'll see in that right-hand column. Many times in the past, as we do our information sessions and bring you what we would call maybe the sweet spots of life insurance carriers, taking a little different approach today that I think all of you will benefit from immensely, perhaps the direction we need to turn to more in the future, and that is helping you make the sales. And one of the most difficult things you have as an agent, of course, is getting in front of people and being able to open the door and talk about life insurance. So with today's presentation of information, we have with us from Prudential, McCrite King. And again, he's going to bring to you today a presentation of information that will be again logged in on our website for future review. But I really believe this is something we all need to see and make part of our best practice. So with that in mind this morning, again, welcome McCrite. And thank you for being with us.
Thanks, Mark, and thanks everybody for joining us this morning. Really hope that over the next little bit we give you something that you can take back to your practice. And I would make the assumption that if you're on this call, you're either actively selling life insurance or you're in a position where you would like to be. So hopefully, regardless of either one of those statuses, you'll get something that you can use out of today's presentation. And Mark, just want to thank you guys. I've had the opportunity to be on this call before, and I really appreciate it. I think it's awesome that you guys do this, and you stay out in front with ideas, and help provide exposure for life insurance opportunities out there. So thank you for that. This is my third time on the call, so if you've heard me before, I'm sorry, maybe, I don't know, hopefully it wasn't too bad, but if it's your first time, then good, you have a clean slate. There's no preconceived notions, but we're kind of in the thick of the summer months right now, and hope everybody is enjoying that and able to take advantage of time with the family and vacations. We just got back from a week at the beach, and it was very nice to unwind and maybe get rid of the phone and the emails for a couple days. Couldn't completely do it, but got close, which was really good. But today what I want to share with you guys is just talking about the life insurance review process and the importance of it, and for your clients, but also the opportunity that it can bring you guys from a business standpoint to help you grow your practices and increase revenue, so on and so forth. As Mark said, my name is McCrite King. I'm the Regional Vice President for Prudential. I cover the Mid-Atlantic. Well, we use that term loosely. It's South Carolina, North Carolina, up to Maryland, and the District of Columbia. And essentially, I partner with agencies like Messer to help provide life insurance solutions. So what we say here at Pru is we help our business partners thrive by offering dynamic underwriting, enduring value, and customized life insurance solutions. And so one of the areas that I like to start with is just helping folks understand where a lot of those opportunities to provide those solutions come from. And just real quick, I just want to take a minute to go through this, but there's mainly 4 areas where we see life insurance opportunities develop. One of those areas would be wealth transfer strategies. So these are clients that tend to be a little bit older in age. I would say 50s and up. They've amassed a significant amount of wealth. Certainly doesn't have to be the amount of wealth where you think of estate taxes or anything like that. I like to say these are people that are doing better than okay. Or you might reference these people as the millionaire next door. Live very humbly, but they love their families, they love their church, they love their charity, and they might want to use life insurance as a way to create some additional monies or tax-free monies that could transfer to those organizations. So we find a lot of life insurance opportunities in that quadrant or that category, if you will. Secondly would be the business planning market. Again, typically we find ourselves working with businesses that have been around for 3 to 5 years. We don't really see a specific type. I mean, we've worked with sole proprietors, LLCs, partnerships, S Corps, C Corps. So really not focused on the type of business, but we really just say it's important that they've been around for 3, 4, or 5 years. So they do have some level of establishment, and hopefully they're turning a profit, making some money, that sort of thing. But really where we're able to help folks in the business world is helping those owners reward, retain, recruit key employees to the firm, and also to help protect them in the event of a premature death through things like a buy-sell agreement. So very important to a business to make sure that they have those things buttoned up. Third, we look at life insurance as an opportunity to help in the retirement planning world. This isn't the right fit for folks, but there's a subset of higher income earners out there between the ages of 30 and 50 that are making significant 6-figure incomes that are taxed very heavily. And recently that burden has become worse with the, it's funny to say, the American Taxpayer Relief Act, maybe provided relief in some areas, but other areas it did not. For example, capital gains taxes on a high income earner went from 15% to over 23%. And so some may look at that and say, well, that's an 8% increase, but in reality, that increase is closer to 66%. So the hit that high income earners have felt due to taxes has been pretty significant. And some people might say, well, so what? They're high income earners, but that is an opportunity where we can use life insurance as another vehicle where these people can put money away for retirement, have that money grow tax deferred inside a life insurance contract, and then if we structure it properly, they can pull funds from the contract in their retirement years to have some diversification in how they're going to be taxed. So most people today we know are funding their 401ks, which obviously I encourage, but every dollar that goes into that is going to be taxable at some point down the road. Whereas life insurance can provide some diversification by having a bucket of money in retirement that can be accessed without having to pay taxes. And lastly, and where we're going to spend our time today, is talking about the basic life insurance strategies, income protection, and specifically policy review. Last year, if we were to break down our business by these 4 categories that I've talked about, the overwhelming majority of life insurance opportunities come from the policy review bucket. And we'll talk a little bit about why we're seeing that as we go through the presentation today. So basically what we're trying to do here is we're going to talk about how you can help your clients make sure that their life insurance keeps up with their life through the different phases, because we know things don't always stay the same. All right, so I'm going to flip over here to So on our agenda today, we're going to talk about why we review policies, some of the opportunities that we can find in that process, and and for an agent what it can do for their business as well too. So we'll talk about some of the external factors that we're seeing out there in the economy and some of in the market, and we'll also talk about some of the newer benefits that are available in all life insurance contracts, and why clients might be able to, or why they want to replace their policies or review their policies to make sure that they're taking advantage of some of these newer benefits. So we'll also talk about some things you need to be careful about if you want to change your coverage or your policy. And then, of course, at the end, if there's any questions, we'll definitely make time to answer any of those. But what I want you guys to think about as we go through this presentation is think about the last 5 clients that you've met with. whatever the nature of those meetings were. It may not have been life insurance. But think about those last 5 meetings. And then I want you to think about the next 5 meetings that you have coming up this week or next week. And think about those clients and ask yourself if you've had a conversation with them about life insurance, or whether you think there might be an opportunity and how you could correlate or intertwine some of this material we're going to talk about today into that conversation. Because many times what I see is a lot of success is generated by asking one simple question, and that's, oh, by the way, can you tell me a little bit about your life insurance? Something as harmless as that I've seen has generated some of the larger and largest case opportunities that we've seen at Prudential. So it doesn't take a whole lot to get clients to open up about the conversation. So first thing we'll talk about is why review your policy. There's a couple different types that we see out there. Obviously, individual coverage, which means you bought it yourself or your client bought it themselves. And a lot of our clients have coverage through their employer that they got when they signed up for benefits. They may have gotten $50,000 or so and had the option to purchase additional coverage through their employer. So obviously, the most common thing we see is, does it still make sense? If they bought life insurance several years ago, is that policy still going to accomplish what they originally set out for it to accomplish? So the goal is to help make sure that your policies are keeping pace with the changes in your life, and could suggest that you could consider modifying the coverage or adding coverage to make sure you're protecting the family effectively. We always say it's a good idea to have all the life insurance policies that you own reviewed by someone like you guys, an insurance professional. So one thing I'll make note of too is this presentation is something that you could actually use with your clients. It is approved for consumer usage. So we'll make sure that you have the opportunity if it's something that might help you facilitate the conversations. So we always ask people, think back when you bought this policy. If you have more than one, what was the idea? Do you remember when you purchased it, what the benefits were, or why you purchased it? And you got to consider now, is it still needed for that reason? Is there something else you need from it? And do you currently have the right kind of life insurance for the current needs, depending on your most current situation? So obviously, we know what life insurance can do for in its most basic form, and that's provide death benefit when the family needs it most. Hopefully, and something that I condone, at least a lot of my personal friends and people that I work with, is focus on having the right amount first. There's a lot of talk out there between owning term insurance versus owning permanent insurance. And there's a time and a place for both of those different coverages. But the most important thing is make sure you have the right amount. Because if something devastating were to happen, you're early on when you have young kids and there's not a lot of savings, it doesn't matter if that money's coming from a permanent policy or a term policy. Just get enough to make a difference. Heaven forbid you ever need it or your family ever needs it. So obviously, we know that life insurance can be there to replace income, keep somebody in their home, continue an education if kids are in college and relying on somebody to pay for those expenses. We know that it's not getting any cheaper to die. I say that kind of jokingly, but recently went through the process of burying a grandparent within the past 6 months and was blown away at what those expenses were. I'm sure a lot of you have dealt with that. And still be able to retire as planned. So we all talk about retirement. Usually we talk about retirement in the sense of, hey, we're going to save X amount of money for X amount of years, and then we're going to retire at 65 or 67, and all is going to be well. But unfortunately, we know that the plan is not going to be the same for everyone. So if you didn't make it to retirement, life insurance can be the only thing that can complete that retirement plan for a surviving spouse or for your family. And then lastly, to help business owners continue a small business. One of the things that I'm very convicted about is that I feel like if somebody works hard to start a business and get it going, then, that business has the right to survive the death of its owner. And one way that that can happen is making sure that life insurance is part of the picture. So we know that life changes. That's a big reason for making sure that we're doing these policy reviews, at least annually, I say. If not annually, maybe every couple of years, just to make sure that things are still in order. So we know that starting out, somebody's situation is going to look like maybe this here on the screen. There's debt, there's student loans, car payments, housing expenses, wedding expenses. I mean, anybody in their 20s and 30s has some of this going on. Same thing for the getting established, buying that first house, becoming accustomed to paying the expenses that go along with that. Maybe you have kids that are in private schools or colleges where there's tuition expenses. These are things that people are going to be dealing with more than likely in their late 40s or early to late 40s, early 50s even, as we're seeing people have kids later and later in life. And then we start to get sort of on the other side of the hump, if you will, where people are more established. And they're looking at their situation and they might be thinking, well, I really don't need that life insurance that I purchased 10 years ago or 15 years ago or 20 years ago. There's enough here that if something happened, I could self-insure. And a lot of people might be in that situation. But frankly, when you look out there and you look at the statistics around how well people as a whole or how well as a whole we've saved money for retirement as a country, there's not a whole lot of people that can say, I'm going to be fine if something happens at this point. And this might be where things shift from having term insurance to maybe having something more long-term like permanent insurance that could be there to help support some unforeseen expenses that might happen during retirement years, such as a chronic illness, where we can have an insurance policy that helps pay for the cost associated with the care that's needed during a chronic illness. Somebody that's starting out in their 20s and 30s probably not going to be thinking about that, just like they're not going to be thinking about estate planning or maximizing their spouse's retirement income. So, it's definitely going to be fluid, just like the life insurance world. So just a little bit more on that. I mean, some examples, obviously, marital status, home ownership, children, other dependents. Those are the things that kind of, hitch over the head, or maybe a guy like me who, has just had the joyful pleasure of being in the life insurance business from day one. We recently found out we were expecting our second child, and, being the nerd I am as far as life insurance goes, I mean, that's the first thing I think about. That's a potentially another wedding. That's potentially another college education expense. There's, probably a lot of smock dresses that are going to be involved there, being from the South. So, I went out and bought some more life insurance just to make sure that I could feel a little bit better about that worst case scenario should it happen. Some of the other things that probably will change over the course of somebody's life is their salary and their income. I don't think anybody that's in their 20s or 30s is thinking that that's going to be the max income that they make, unless they're a professional athlete or something. Then that might be their peak income earning years. But I sure hope that throughout the next few years that I have an opportunity to make a little bit more money. And maybe a few of you feel the same way. But also employment status. It's life is a little different than how it was, maybe even 15 or 20 years ago. I had two grandparents that worked with the same place for 50 plus years. And, I've been in the insurance business for 11 years. And one time voluntarily I made a change, but two other times the change was made for me with mergers and acquisitions and things of that nature. The other thing that's changed through that is the type of benefits that I've been provided through those employers. And fortunately working for a company like Prudential, to use that as an example, we think highly of life insurance, and we've got some pretty good options. as far as life insurance that's provided through the employer, but not everybody's situation is the same as far as that goes. And then lastly, we know that health is a big driver of life insurance, or the ability to get life insurance and the ability to afford life insurance a lot of times. And frankly, what I see is that nobody wants life insurance until they realize that they might not be able to get it. And that's where we see a lot of situations where clients that 6 months ago or a year ago or a few years ago were in great health, but they've had that life event. They've had that heart attack. They had that cancer scare, or they had something that may not prevent them from being able to get it, but it's probably going to become more expensive for them to get it than it would have if they would have jumped on it before that condition arose. So, I mean, even there's mixed feelings that I hear all the time about people buying life insurance on their children, for example. And, people have mixed emotions about that, but my wife is a nurse. She works with kids, and specifically in the oncology world. So, they're kids that are, 2 or 3 or 4 or 5 years old that have been diagnosed with cancer from a very early age. Their ability to get life insurance is always going to be compromised. And so buying life insurance at the youngest age possible, just to protect that insurability. And we're not talking about putting $1 million on a kid. We're talking about, $25,000 or $50,000 with purchase options can lock in somebody's insurability for the rest of their life, because we don't know how our insurability situation is going to play out in the long run. People also tend to think a little bit differently about their goals, their concerns, their finances as they get a little bit older. I kind of mentioned this a second ago, but if you try to have a conversation with a 30-year-old about estate planning or chronic illness planning, you're probably not going to have too much success with a sale there. I mean, you might have somebody that's way overly paranoid, but point being is that most people are thinking about protecting their family and covering the basics at that age. However, I'm not 50, so I can't say this from personal experience, but there's something about hitting the ages of 50 or 55 or 60 where you start doing a little introspection and you think about your family a little bit more in kind of the long run and what things might be like without you there. And so that's where people start thinking about their legacy planning goals, if they have any. It's not everybody's desire, or what they might want to do for a church or a charity that they have an affinity towards. And that's where they could possibly look at life insurance as in a lot different light than they looked at it when they were 25 or 35 years old. Take a sip of water here, excuse me. So what's changed around us? I think whether you've been in the business for 5 years or 10 years or 15 years, we could all agree that there's been a lot of changes in this business. Just the economy as a whole. We've been on a roller coaster ride a little bit, for the past decade. And although the markets look really good this one week, who knows what could happen today or tomorrow or the next week. We also know that there's been a lot of changes with medicine and longevity. And that's really important to understand, because since I've been in this business a relatively short period of time, in 11 years, I've seen the mortality tables change twice, which means that, it's evidence to people living longer and longer, and which is a really good thing, but the unintended consequences of that are people outliving their money in retirement, and also people living longer but possibly not healthier lives. And so that's why we see, and if you look at statistics from longtermcare.gov, a married couple that's 65 years old has a 70% chance that one of them will experience some sort of chronic illness during their lifetime. A chronic illness meaning they need help with 2 of the 6 activities of daily living, or they have a severe cognitive impairment, which requires care. There's a 70% chance that that will happen. And unfortunately, what we know is that 90% of Americans have done no planning for that. Not one bit of planning for that could be inevitable for many people. Just personally, my grandmother that I mentioned that passed away back in December of last year, she was 89 years old, but spent the last 7 years of her life receiving care. The first 2 years we paid for around-the-clock home health care, and then the past 5 years she was in a skilled nursing facility to the tune of about $8,700 per month. And so fortunately, my grandfather had done a pretty good job of saving money. He probably would have liked to see that money go somewhere else. Not that I'm a greedy person, but hey, a little money here or there wouldn't have been so bad. But we literally spent every dime, with the exception of $10,000 in the past 7 years, on her care alone. So we were fortunate on one hand to be able to do that. But we know there's a lot of people that situations would be much, much different should they experience the same thing. And also the industry, because of some of these changes with longevity and chronic illness, the products that we have out there in the marketplace are much different. So if you bought a life insurance policy that you've had for maybe 10 or 15 years, there might be a lot of features today that weren't available when you originally bought it because of some of the changes in the tax code. And then just, frankly, because life insurance companies have become a little bit more innovative in what they're able to offer. So it's always important to look at how the policy has been responding or performing. One thing that I didn't mention is with the economy, what we've seen since the late 80s, obviously, is a huge drop-off in interest rates. And there's been a lot of policies out there, especially permanent contracts, whether they're whole life contracts, universal life contracts, variable universal life contracts, doesn't really matter. If we haven't done a good job of reviewing those policies, what we'll probably find is there's a good chance that they didn't perform the way that we hoped that they would when we bought that contract. For example, the universal life contract that you bought in 1990 might have been crediting an interest rate of 10%. Today, that same policy is probably crediting an interest rate of 4% or maybe 5% at most. So if you didn't go in and review that contract and pay premium, then over time, that policy would basically eat itself up, taking any values out of the contract to help cover the cost of the premium. So if you've had clients in that situation, they probably got a notice at some point that told them their life insurance policy was going to lapse, and maybe they had the opportunity to replace it, or maybe they didn't. But we're still seeing a lot of that in Prudential, where there's some policies that should have been reviewed. Some we can help, and some that are a little bit too far gone, but also something to keep in mind. So probably the easiest analogy that I could relate back to this is thinking back to your first cell phone. I would probably venture to guess that no one on this phone call today has the same cell phone that they originally purchased. I could be wrong. I certainly do not have the same one I've been through. I'd be ashamed to tell you guys how many cell phones I've been through since my first cell phone. Some because I just had to have the latest, and some because I'm just really careful with cell phones. But either way, what we know about cell phones is that if you wanted the, I call it the Zach Morris cell phone from the late 80s, you would have paid about $4,000 for that cell phone. And as you know today, although we still think some of the prices might be ridiculous for a new iPhone, you're not going to go anywhere and pay $4,000 for a cell phone. And you're going to get a whole lot more bang for your buck today, having a camera, Wi-Fi capability, all the apps that you can stand, and you're going to be able to get all that for well under $4,000, we'll say. So the point here is with life insurance is that one of the big drivers of cost is mortality. And as I said a minute ago, people are living longer and longer. And because of that, life insurance companies have revised rates over the past 10, 15 years, especially on term insurance, where a term contract actually might be cheaper today than it was when somebody bought it 15 years ago. Now, obviously, we have to keep in mind that same client would be 15 years older, for example, or 10 years older, so it may not be cheaper. However, keeping all the variables to say life insurance on the whole is less expensive today than it would be 10 or 15 years ago. The other thing that it has changed is that if you were to buy a term policy in the early 2000s, for example, or before that, a company may have only offered you a standard rate or a smoker rate, whereas today you have rates such as preferred or preferred best, allowing clients to get a better rate than they would years ago. So a lot of times we see if a policy is not too old, we can actually review that policy, make a change, get somebody into a new policy paying the same or less premium with more features and benefits. So it's kind of get the gist there. So this talks a little bit about life expectancy. Point is, this basically shows that life expectancies have gone up, and therefore companies have adjusted their mortality tables because of that. So now a permanent contract today will actually show it running through 120 or 125 years old, whereas 10 years ago you didn't see policies that went past 100. So I haven't seen anybody live that long yet, but I guess they're expecting that it could happen sooner than later. So a couple of things to look at specifically to permanent insurance. If you have clients and you ask that question, hey, do you have life insurance, or tell me about your life insurance, and you find that they do have a permanent contract, you might just want to ask them the question, when was the last time that you had that reviewed? Because what's going to happen more times than not, if they haven't reviewed that policy lately, and it's at least 10 years old or more, there's probably a good chance that contract has underperformed. So this might be an opportunity to enhance, get that client the coverage they intended for the same amount of money, and make sure that it lasts for the duration that they expected it to last. So I mentioned a second ago with some of the new innovation in the industry, the living benefits. I mean, life insurance more than ever, I should say, has more benefits than we've seen. Of course, it's a death benefit product, but now policies offer cash value that can be used during lifetime for whatever needs. But they also provide living benefits such as chronic illness riders or long-term care riders to help with the costs associated with that. So, like I always tell people, I mean, life insurance is for the living as well too. If it was purely about the death benefit, we'd probably call it death insurance. But life insurance is truly a 3-in-1 product. It can be there in the event of a death, a premature death. It can be there in the event that somebody lives too long and they need cash to help support retirement, or it can be there in the event of somebody getting sick along the way and being able to access the death benefit to help pay for that care. So we have a rider at Prudential. I don't want to spend a lot of time on this, but basically if you have a permanent contract with Pru and you become chronically ill, which again is an inability to perform 2 of the 6 ADLs, or you have a severe cognitive impairment, you can accelerate the death benefit dollar for dollar. We don't require any receipt, so we basically write you a check each month, or your client a check each month, and they can spend that money on anything that they want to spend it on. So literally, if they want to use it to cover the cost of groceries, or to build a ramp into the house so that it's accessible, or to fit the bathroom out so that it's handicap accessible, they can use the money to do that, versus having to keep receipts documented and submit receipts to the carrier in order to get reimbursed for those expenses. So that's an indemnity benefit versus a reimbursement arrangement where you have to be very documented on what you spend the money on. So if you want more information on that, we certainly can provide it as well too, but that's available just on our permanent insurance contracts with Prudential. So kind of wrapping this up, what can a policy review do for you? Number one, we're going to talk about the type of insurance you have, whether it's term or perm, what you need, what you want, so on and so forth, the duration of insurance. Do you need the coverage to last another 5 years, 10 years, or would you like it to last for the rest of your life? Because you do have those legacy planning goals, and you can't do that with term insurance, unfortunately. The importance of cash value, if you're one of those higher income earners, or if you're somebody that sees the value of having more money that's going to be there in retirement that you can get without paying taxes, life insurance might be a good thing to have in your portfolio. And then again, not to beat a dead horse, but the additional living benefits, riders that can help with the chronic illness expenses that unfortunately we know could be a very, very devastating circumstance for somebody that's nearing or in their retirement planning years. You also might discover that your policy is not performing to your expectations. There could be situations where you might be able to decrease your out-of-pocket premiums. I see a lot of situations where clients have had policies for a while and they've done a good job of funding them and paying more premium as necessary, and they have a really high amount of cash value compared to the death benefit that is in force. So many times we can take that cash value, if it's appropriate, move it over to a new contract, get them more coverage with no additional out-of-pocket premiums to have to be paid. Now, the other side of that is we find a lot of times that clients need to pay more premiums, or they might be in a situation where they need to get rid of that other policy at all and get into something that might be better for their circumstances. Do you have the right amount? Again, should we increase coverage or decrease coverage? Maybe at a point where there's no debt, you've got maybe your legacy goals taken care of, and you're carrying more insurance coverage than you actually need. Or there might be some other situations out there that you haven't addressed that you need life insurance for. So this is a quick case study that we worked on earlier this year. 55-year-old female had a whole life policy that she had bought 15 years ago. And so when she bought this 15 years ago, it was what she wanted. It was what she needed. And it's worked reasonably well for her over the past 15 years. However, now her current goals, cash value is not important to her. She would like some stronger guarantees in the contract. And, like a lot of folks, she wants to reduce her out-of-pocket costs. And the other thing that's changed a little bit is because she is 55 years old, and at 40, she wasn't thinking about chronic illness concerns, but now she is. She actually had a mother that was diagnosed with Alzheimer's, and she saw the amount of time it took for her away from her family and the money that it cost to take care of her mom. So she's thinking, I don't want to be the burden on my family, that unfortunately her mother was on her because they hadn't planned for that situation arising. So she had bought a policy. The current death benefit on that was $587,000. There was no living benefits on the contract. She had a net cash value of $130,000. Her annual premium was a little over $6,000, and her cost basis in the contract was $95,000. That's what she put into the policy. So what we were able to do through a policy review is get her a new policy, which increased her death benefit amount from $587,000 to $700,000. So $113,000 increase in the death benefit. We also were able to add the benefit access rider on there. So you see the bar total benefit. That's benefit access rider. So that is the amount of money she would have available to spend on chronic illness expenses should she need it. Now, if she were to take that out, using that, it would reduce the death benefit dollar for dollar, but at 80 or whenever that chronic illness might pop up, the bigger focus might shift on covering those expenses, and then the death benefit need might be secondary. But just to clarify, it's not a separate pool of $700,000. That is the actual death benefit. So we did a 1035 exchange, which allows us to bring over the $130,000 from her current policy to the new policy. That's a tax-free exchange. The IRS that's a tax-free exchange through IRS code 1035. And instead of paying $6,300 a year, we were able to lower her premium to $3,500 a year. So we almost cut it in half. At the same time, increased that death benefit by $113,000. So that policy is guaranteed out to 120. As long as she pays her premium on time, that policy will not lapse. It's guaranteed to make it all the way out to age 120, which, might be longer than most people feel like they need their coverage for, but it's not a huge savings, frankly, if you ran it to age 100. The difference in cost is very minimal from age 100 to 120. So again, the product that we use there is the Universal Protector. It's a permanent contract. It offers a no-lapse guarantee. It is somewhat flexible in that you can change the timeliness of your premium payments, but you want to make sure that if you do that you have an in-force illustration run to make sure that what you're paying and when you're paying it is still sufficient to run that guarantee out to the age that you originally intended. It's not really built to take loans and withdrawals from. If you do that, that could mess up the guarantees. But like most companies, really all companies that offer these type of products, you're not going to see a whole lot of cash value accumulation. This is really for people that are getting a little bit older. They're really more concerned about the guarantees and accumulate values inside of their life insurance contract. So just to recap, we've gone through the reasons why, obviously evaluating why the original purchase was made, assure that the coverage is keeping up with your life. We want to talk about policy performance, make sure that what you bought is doing what you had intended it to, and if not, that we make the necessary changes to either save you money or get you more coverage, whatever it takes to meet those whatever those goals are at this point in time. So a lot of times when we talk about policy review, a lot of people automatically think that means replacing a contract with another contract. And I'll tell you that a lot of times that is what we see happen, but that doesn't mean that's always the right thing for the client. So we just have to be really careful that we're doing our fiduciary duty and we're being responsible when we look at replacing a policy, because in my position, I'll tell you point blank, I've seen situations where somebody was having a policy replaced and it probably didn't make the most sense for the client. And unfortunately, we're going to see those scenarios arise, and that's the nature of the business. But I can tell you that overwhelmingly, I've seen more situations where we have been able to help clients and do the right thing and get them in a better situation as far as their life insurance goes. And that's something we can feel good about. And when that check hits our bank account, we can feel good about that too, because we've done the right thing for our client. This is kind of a boring page here. I'll just mention a couple of things. Obviously, if you replace a policy, then of course that's going to come with underwriting. There could be new surrender charges on the contract, a new contestable period. So there are some things that you want to make sure your client knows and understands about purchasing a new policy and replacing an old policy. The other stuff is really a little bit more in depth, so I won't go into all that. We could circle back to it if anybody has questions on it. Benefit access rider, we've talked about that. So that really sums up. Again, we talked about the 4 areas where we see coverage. The kind of the wealthy family bucket, the business owners, the high income earners, and then of course we talked a lot about policy review, making sure that people have the right amount, the right type of coverage. So like I said to start the call, I really urge you to think about the last 5 people that you met with, and just think back over those meetings, and was there an opportunity to ask about life insurance if that wasn't what the meeting was about? And then again, think about the meetings that you have coming up. And maybe you set aside 5 minutes or 10 minutes somewhere in the conversation to ask that question. Hey, I noticed that we don't have your life insurance. Can I ask you when the last time that you had it reviewed was? And just see what happens. Because I guarantee a lot of times you're either going to get the answer of, I don't have life insurance, which we know there's an opportunity there, or it's been a while since I've reviewed my life insurance. And a lot of times there can be an opportunity there. So thank you guys for listening. If you do have any questions, I'll be happy to help out. And we appreciate the opportunity to be on the call with you this morning.
Excellent, McCray. Thank you very much again for sharing this information with our agents. Again, as
yes, sir.
I began the meeting this morning, letting you know that I felt you were going to be spending your time, your valuable time, even though it's the summer months and we kind of got that itch to get out and do things, getting a learning experience that can benefit you immensely going forward. Again, just what was touched on at the very end. When you're meeting with a client or reviewing the past meetings that you have, which you can still go back to those same people if you fail to ask the question, give them a call and ask them the question, or one of two questions. And again, those are so easy. How long has it been since you've had your life insurance reviewed? Or do you have the old or the new insurance? So in both cases, you're going to get one of two answers. Number one, how long has it been? So they're either going to tell you, boy, they haven't had their insurance reviewed in years, or they don't have any. And again, when you ask the question, do you have the old or the new, the first question they're going to have for you is, what's the difference? So again, you've got an opportunity to go back and do some additional new business. Again, wisely stated by McCray, replacement is not always the correct solution for your client. So as a fiduciary responsibility that we all should have, let's always try to do the right thing. Let's not replace just for the sake of a commission. But also, speaking to the commission issue, if you're going out and reviewing a policy such as a term product that you wrote in the last 12 months, I might caution you on waiting to replace that policy until you get beyond the 13th month, just in case you have that with a carrier that might charge you back the entire commission. So be sure to be very cautious in that concern as well. As again, it was brought to your attention, in the very beginning, you got 4 different opportunities out there, and McCray was very careful to give that information to you to recognize where those 4 opportunities can be within that clientele that you meet with. So every person out there is probably going to fit into one of those 4 categories. And asking those basic questions and recognizing, again, as you go through the life changes, recognizing and reviewing that very important page, I think. Again, this presentation will be posted on the Messer website on our learning curve area. So you can go in there and bring it back up and review that or take some notes so that you really can say, all right, I'm meeting with the 35-year-old. Are they sitting already in the getting established, or are they late bloomers and they're still getting started? And know what you're looking for to help them. Looking at the mortality tables that were brought up to you today, I mean, that's pretty strong information to say that when you've got couples over the age of 65, there's a 70% chance that one of them are going to need that care. And then a statistic that actually I ran across yesterday that stated that in today's mortality, and again, that was brought out well by McCray, that those tables have been redone twice in the last decade. And before that, I'm going to say it was 40 years. I mean, it was a long time before those tables had been re-executed. But today, I heard a statement yesterday that said that a 65-year-old couple have a 70% chance that one of them is going to reach age 95. I mean, that's where it's pushed up to, because I think the last table McCright, that your screen showed was like 2008. So,
Right.
here we go again. People are living longer, and of course that brings up that big challenge that more and more people getting into the retirement age are already facing, and that is there going to be enough money for them to live through that retirement stage? So again, no better answer, no better solution than taking control of it yourself with life insurance. So again, I give you so much thanks for bringing this to them. I see you got another screen up there now. You want to talk a little bit about that policy review?
Yeah, this is just real quick. This is a piece that, again, we'll send it out there, but these are just some things to think about. Like if you're thinking about those meetings that you might be having, kind of on the left side, it talks about the client profile. And these are all the situations that you might find that could generate the opportunity to do a policy review. And then on the right-hand side, it has some questions to ask. And these are all, obviously to the idea of provoking a conversation around an insurance review. Obviously the first one there being, has it been a while since you reviewed your life insurance needs? Have you gotten a new job, which would insinuate that maybe you don't have the same group coverage that you did, or maybe it's better. But this is just a helpful piece, and this actually goes through a lot of different situations that we talked about kind of to start the conversation. But this is a nice little reference piece that is available to use with your clients.
Yes, thank you, McCright. And if as an agent you're just a little bit hesitant of how do you do things, again, these type of pages added to your presentation or added to your white pages or yellow pages, however you're doing it, can give you that little extra commitment or the feeling that you're able to respond in a way that your client feels you do know what you're doing. Kind of important. Also,
right.
Yeah, please, all of you agents, if you're not already contracted with Prudential, as McCright said, he's been with us before, and you've got an opportunity to go back on our website to the Agent Resources to the Messer Learning Center tab, and you can click on the Just Added section. In about 2 days, you're going to see this presentation up there for you. But you might also want to go back and see some of the other ones that we've had up there in the past. And when you do, you're going to find that one of the ones that we had McCright do for us was on the impaired risk type of client. And it's one of the greatest benefits you have working with Prudential, because oftentimes an agent will call me and say, well, Mark, who's more lenient in their underwriting? Well, it's really difficult for me to say there's anyone that doesn't look at the circumstances of health pretty much the same in the industry today. However,
right.
I will say that when you're looking at Prudential's underwriting, there are some sweet spots that agents don't become aware of unless they do ask the question. And if I'm just going to answer it and say, well, if you want a little bit more leniency in underwriting, I'm going to have to actually lean towards Prudential. Again, it's not going to be specifically that case that's had that cancer or that's had that diabetic situation, but there's certain things that they will give you benefits on. One of them happens to be on the tobacco use. Now, perhaps we're seeing less and less people smoking today, but if you're living in North or South Carolina, which have been tobacco-based states for so long, Virginia, unfortunately, we still are going to run into people that are using those products. But again, there might be some consideration and leniency for them that you might not have found anywhere else. Perfect example I'll bring to your attention that I've personally used. Anytime I get one of these new smokeless product electronic cigarette people, Pru is the one to go to. They're going to give you a standard non-tobacco on that particular usage. Everybody else is going to call them a smoker. So just another one to put in your back pocket. Usually, too, those are going to be your young and up-and-comers that are doing that today. So we're back to the starter. We're back to, talking about selling them just some basic term life insurance. Oh my gosh, I forgot one of the most important ones. What McCry touched on today with children. It is a difficult subject when you're sitting with parents and you're wanting them to look at life insurance for a child without making that feeling of, why would I buy insurance? I don't want my child to die, bringing up that negative. But most importantly, what he did bring up to you was getting a policy on that child, even if it's just a $25,000 life insurance, that allows them to have that insurability going down the road to increase that face amount based on their health having some issues. That if you don't get it going now, you close that door. So, that's
Right.
probably the best place to go to help you write some child insurance. I don't have any other questions here on the board this morning that to us. Oh, we do. Here's one, and this probably directly affects back to Prudential. How is the occasional marijuana use rated for an adult age 38?
Okay. So we're actually very favorable on marijuana usage. So if you use marijuana 3 times per week, so 3 times per week or less, and it's admitted use, then we will rate you non-smoker plus, which is it's a class that we consider a preferred class. It's our 3rd best class, but you can actually test positive for it, and as long as you admit to 3 times per week or less, you'll still be non-smoker plus. Caveat it by saying if you don't admit it and you test positive, it's a decline. So we're kind of using the honor code a little bit. So you're best to be upfront about it, especially if you test positive. But we're gonna be able to look at that pretty favorable within those parameters.
Excellent, because that again is the type of question. Alan, thank you very much for that question. That had you called in here, I would have definitely led you immediately towards Prudential, and again, making sure of that caveat to state, hey, yes, I do use it, but I use it twice a week. So there we go.
Right.
That's it for today on my end. You have any other closing statements, McCray, that you might want to share?
No, I think we've hit it pretty good. Just thank you guys. If you've done business with Pru, I thank you greatly for that. If you haven't yet, and you have a situation come up, I'd love for you to kick the tires on the Pru bus and see how we can help you and help your clients. So thank you guys.
Again, McCray, thank you. Thank you for everything that your organization has brought to us in the past. Ladies and gentlemen, thank you all again. We'll look forward to having you with us again next Wednesday, when we will once again bring to you some additional information, share with you some thoughts, and give you an opportunity to increase that life business. Thank you all again. Signing off.
Thank you.